Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Chris Sugden joins us today from Chattanooga, Tennessee. Chris is the chairman and managing partner at the growth equity firm Edison Partners, where he has invested in companies that include Zealous, Moneyline, Billtrust, among many others. Prior to Edison, he held a variety of operating positions, most notably being the CFO at Ecom, where he helped scale the company more than 5x into a successful acquisition. Chris, welcome to the show.
Thanks for having me, Nate. Great to see you.
Of course. It's a pleasure to have you. Can you walk us through your background and your path to Edison?
I'd love to. I get the question a lot because people notice I started out as an accountant when they look way down the LinkedIn scroll. And being a CPA is not a normal route to VC or private equity. But the long story short, 3 or 4 years as an accountant. And a shout out to any young people listening, because I think being an accountant is one of the best training grounds you can get, because it all begins and ends with, can you read a set of financial statements? And it served me well in my career. But I jumped to the startup world pretty soon after. In fact, became a CFO of a company that this happened twice in my career before joining Edison. The CEO had a young guy, started a men's magazine targeted at the younger crowd. You may know Details magazine or GQ, but a younger version of that kind of meets Fast Company. And this 26-year-old founder wanted a CFO that kind of looked like the audience. So the good news was I qualified as that, but I didn't qualify as a CFO. But I, kind of jump in with a challenge and off you go. So we were backed by both a strategic and a financial investor. That lasted about 4 years. Publishing business is a tough business because we were literally an old school magazine. Grew that actually really well. And the whole idea was create a social community before things like the connectivity we have now and the phones we have in our hands made social make sense. This is back kind of mid 90s, late 90s. And then I jumped into a payments company in the internet billing space, what we call online payments today. And it was really the forefront, late 90s, kind of pre-dot-com bubble into the dot-com bubble and before the burst. So I was CFO for a second round. Then I became COO2 of that startup. So I saw a front row seat as a CFO, as employee number 6 of a company that had a couple $1 million and raising its A round. But a similar story, the A round investor wanted a CFO. This time actually had some qualifications. And I had a Princeton professor as the founder, believe it or not, a true rocket scientist because he was a physics professor. And he literally, the first question he asked me, what does a CFO do? So I like to say joining this sort of side of the table as a VC, as a PE, growth equity investor, I spent the first half of my career on that side of the table, if you will. And some might refer to this as the dark side, the stuff we do for a living. But I guess my training and all that leading up to Edison is I have a real appreciation for the real stars of the show, or the entrepreneurs, the management team, the people who get it done every day. We'll get into this maybe depending on where you want to go. But I think the era of celebrity VCs and celebrity PE investors is way overdone, and it kind of needs to stop. And the real hard work gets done by the folks who show up every day and have to make payroll. And we're about to find out how hard it gets when it isn't so easy. When the tide starts to go out, as we're dealing with the macro kind of stuff that's going on. But all that being said, 15 years CFO, COO track, CPA to start. I literally met the founder of Edison in a golf tournament, and I had to, at one point or another, pitch one of his partners for the billing and payment startup that, and they turned me down. Probably a lot of good reasons, turned us down a couple times. But our business was in Princeton, New Jersey, so we were just down the street. And long story short, gross margins are too low, valuations too high. Not sure we believe an adoption of online billing will take place as fast as you say, which of course it didn't. It took a long time. So many of the nays were actually correct, but I told them they're just, they're missing the boat. They're too old. They don't get it. Everyone's going to be paying their bills online tomorrow. But he did say, this is the founder at that point at the golf tournament, when you sell that business, come and talk to me. Let's just chat. And frankly, then I just go into one of the portfolio companies in Edison. Fast forward, I've been here 20 years, and we actually, I was the leader of buying the founder out and kind of moving to the second generation of the firm, if you will, here about 10 years ago, 11 years ago. So we're one of the few firms, I think, that have navigated a founder transition really well, sort of navigated an evolution from what was venture, but with some revenue. We can talk a bit about what we do for a living, to more of a growth equity focus in the last kind of 4 funds. So last year we raised Fund 10, a year and a half ago, and we'll probably be back with Fund 11 next year. So that's the quick version, but that wasn't so quick. So I'll probably should pause. And
how big was the A round back in the late 90s, early 2000s when you were raising it?
It was actually a relatively big one. So this was 1997, 98, except it was Q4 into Q1. It was a $10 million round.
Okay.
But you were starting to see the early days of the dot-com bubble percolating. I mean, really, I say early days, we're probably a year or two into it. And he swore the company's going to be worth $1 billion, in a week type of deal. But I do vividly remember it was about a 50 million pre, 10 million bucks, and we were doing a couple bucks of revenue. So some of that sounds very similar to what we've just been dealing with the last several years. But it was Princeton, New Jersey based, which kind of like we talked about before, underserved geographies is kind of unique in that I've kind of spent my career, while New York's certainly a well-served geography for fintech, beyond New York, we've spent most of our time, and I personally spent most of my time outside of any of the kind of hotter markets, if you will.
Yeah. If I'm recalling correctly, I think Edison has made, over 230 investments. I believe all of them are outside of Silicon Valley. Is that right?
Yeah, it's pretty wild. Someone was kind of quizzing me on that. So I went back and did some work just literally in the last 2 weeks. I was trying to make sure I could say that truly and go back to Edison 1 and 2, and the records may not be so well kept, but literally founded in 86, right? So you go back and see what data you have, and it looks like we've never done an investment in Silicon Valley. I can safely say in the last 20 years, 100%, but I'm pretty sure it's all 36 years. So yeah, 240 plus investments. We actually just closed an investment last week. Never in the Valley. In fact, a whole bunch of Northeast kind of corridor. For the listeners that might know the kind of Amtrak that's one way we kind of think about DC to Boston. And frankly, early days of my career here, New York was, kind of a blip. It was still sort of trying to catch up. There was something called Silicon Alley early days that people were trying to coin around the marketing advertising space. But long story short, the thesis of Edison's founding was actually there must be deals outside the Valley, which is kind of interesting. So our founder literally putting a stake in the ground in Princeton, New Jersey, where we're headquartered. And you sort of say, well, you're right outside New York. We were, but remember New York going back 30 years and even 20 years ago was a bit of a ghost town. Now in the last, 10, it's become, is it the second market or the third market, depending if you talk to someone from Boston. But long story short, yeah, we're big believers in what's going on outside and always have been. But you're seeing it, I know, your firm, your day job, like my day job, we spend a lot of time and we've really seen the Midwest and the Southeast really take off in recent times. And it also drives me crazy when people talk states, right? Because really they're ecosystems around different cities, which I probably spend more time on. But yeah, each of the interesting, kind of cities around the country that are beginning to show up, and COVID's driven some of that even faster, I think.
Yeah. One of the facts that our general partner shares that I think is a great one is Chicago today has more unicorns than Silicon Valley did 10 years ago. So as we think about technology being pervasive across some of these non-coastal hubs, it just goes to show that these companies can be built anywhere today. And that's not to say that they're going to be built at the same velocity or the hub is going to grow at the same rate as Silicon Valley. Of course not. But right. It does go to show that there's real validity in the thesis.
That's absolutely right. And you've seen it accelerate even more so, sort of through the last couple of years, remote and all the things that have been associated with the last few years. Some have kind of boomeranged back to their roots, right? Getting away from the big cities, work from anywhere. So people start to be in search of kind of more balance, and they're starting to find and/or cost of living, frankly. So you're seeing all kinds of drivers around that, to your point. What we've seen, frankly, this goes back probably 10 or 12 years, a city gets a unicorn, to your point. I think about Indianapolis, which has been a great startup kind of tech city. Exact Target hits it big. Salesforce opens an office, and all of a sudden you've got just a bunch of people spinning out. And now Indy kind of becomes an interesting hub for, startups, an example, if you will.
Yeah. Yeah. I'd love to pick your brain about the history of venture because you've been investing now for over 20 years and the industry has changed quite a bit since the late 90s, early 2000s up until today. From your perspective, how much has the industry changed over the past 5 years relative to the previous 15? Would you say the change has been fairly linear or has it been especially exponential as of late?
No, I think exponential. It's a great question and kind of reflecting that kind of time, the temporal kind of idea of 15 and then the last 5. The last 5 has just been incredible, right? The bursting of the funds being raised, new firms being started. Like you said, it's hard to call something a unicorn when there seem to be sprouting every, day or week at least. So even all of that has been pretty amazing. I think there's a lot about the dot-com bubble, having lived through it as both an operator and then joining this firm in 2002, that are similarities. I've been saying to myself, even entering this tumultuous period, the last, 6-9 months, certainly in the public markets, and you've started to see it, show up now in the private markets, which you always do. There's always a lag effect. But I think the biggest difference between back then and the dot-com boom and bust versus this one, which I'm not calling it a bust, but we're going to go through some pretty painful periods here. There are real businesses that have been funded. I think the valuation train ran away from us in a big way. So that's kind of the 5-year run we've seen versus the 15 or even going back again, 15 or 20 years. Overfunding businesses happened back then in terms of too much capital chasing, too few deals and certainly too few, for lack of a better word, quality deals. I think the good news is the quality's up the last 5 years. The vernacular, all the words we use are actually being practiced. So people are focused on unit economics. People are focused on go-to-market models. Frankly, it's great when I see young firms, young people in the business that start their own firm. They're actually focused on those things. Back then it was, we'll figure it out later. And all the goofy metrics that had to do with the kind of vanity. There's still some of that. We saw some noise, certainly in the last 5 years of, kind of just when things are booming, things get funded that probably shouldn't. But for the most part, it's been pretty good investing sort of diligence, if you will. But here's what it really happened, right? The meteoric rise of fund size has sort of, the biggest change to me is the tail wagging the dog. So what happens is the venture or growth equity investor, because we know growth in many times kind of did late stage investing too in the last 5 years. You had fund managers, guys like us and gals like us, managing really big funds, sort of telling entrepreneurs they should raise more money. And now we're going to find out that was the exact wrong advice to be giving folks. And it should be the business model that's driving it. You don't call it milestone. I don't think about investing in milestones, but we generally invest in a round that would get the company to profitability and then have a decision, right? If it's not already profitable. So we also invest in companies that aren't in search of product market fit. So we think about execution risk. That's a little different from early stage venture for sure. But long story short, I think fund size led to round size, which also led to valuation booming. We've seen the valuation movie before, maybe not quite as egregious as it got, kind of in the heat of the pandemic, but we saw that actually with the public markets too, right? Now that reckoning's happening. But I do think round size is getting big because the funds were big, wasn't exactly a big recipe for a reckoning. So that's the biggest difference in the last 5 years I would point to. And that sounds a little bit like I'm talking my own book, cooking my own food here, because we've stayed relatively small for a growth equity firm, just under 500 million our last fund. It's kind of by design. We want to invest kind of 10 to 30 million bucks in a stage where that's the right amount of money to get the company to a really interesting place. Mm-hmm. Is it a strategic sale? Sometimes they get public without any more money. But now in this current market, you can take them to a PE firm and you have a recap kind of option where you roll, founders can take some off the table and keep on going. So from my perspective, all raising too much money does is it limits your exit opportunities. Yeah. Not only of course, creates an expectation that's really high for an entrepreneur, but that just got lost, right? The entrepreneurs forgot, the plot was lost on how much do I own? How much am I going to own? And if this thing goes south, where's my investor going to go, right? Because a lot of times we saw it, right? It was throw a big round in at a really high valuation. If it doesn't work in 6 months, I move to the next deal. That's sort of, and are you really going to stick it out with the company to go figure it out? That's the other, I think the second thing that's really changed besides capital rounds and with fund sizes, sort of this whole notion of value add. I think it's a controversial one in the VC land because VCs would say there's no such thing. We pick a great team and let them run. I think in growth equity and buyout and private equity land, we think a lot more about how can we influence the company. And I would say there's some really good models out there and some not so good models. In the stage we invest, kind of 10 to 20 million in revenue, we like to think of it as a pull model. We've got a whole platform for value add. And what's happened in growth equity and private equity is value adds become not only a cliche, but everyone's got something. The question is, what do they really have, right? Yeah. And to me, entrepreneurs should be looking for a lot more than capital, right? In early stage, it's network and connectivity in the next round and, kind of pressure test the idea, the model, et cetera, and help the company find developers. But later on, it's a lot more than that. I'm a big believer. We've invested a lot of money in what we call the Edison Edge. And that's not for every entrepreneur. But we find is outside the valley, most entrepreneurs do value. I know I got to this point. Can I get to the next point? So I think that's another thing that changed is we see a lot more value add kind of capabilities and discerning entrepreneurs can go get that if they want it.
Yeah. Edison Edge was one of the areas I wanted to touch on today. I'd be curious, what does Edison Edge entail? And in general, how do you think about winning the right to partner with a founder as we see a number of these multi-stage funds start to look more like an enterprise versus a venture firm?
Yeah, we're certainly, again, at a modest size relative to AUM, but a real kind of pound for pound investment in the Edge is very high, if not the highest in the market. We've heard that from LPs. And it's very intentional. When I took over from our founder, one of my founders, a company called Bill Trust, which just transacted going from public to private and a nice win. It was an over 10x win for us. One of my first deals back in the day. I remember that founder, one of my favorite CEOs to work with still to this day, sits on boards with us, said to me, so I look around your table, Chris, who's going to help me north of 50 million in revenue? Who's been there and done it? Who's seen the movie? Because if we do what we're supposed to do in 3 years, your ideas are going to be old ones for what I'm doing. So the Edison Edge is born out of, talk to CEOs. What do they need? What are they looking for? The firm at Edison had the Edison Director Network was sort of the first pillar. We take 2 board seats in every deal. And one of the pillars of the Edge is the Edison Director Network. We're big believers in more operators at the board table than investors. When investors outnumber operators, I think that's a recipe for disaster. And that's from early on all the way up, frankly. And you kind of see it play out, especially in times like this, because the investors they're sort of a one-track mind a lot of times when things are good or bad. And operators are much better at delivering tough news or bad news or asking hard questions. So the Edison Director Network existed, but that was really it when I got here. We hired a woman named Kelly Ford, who recently became our COO, to be our first kind of operating partner, but full-time. I didn't want to have operating partners who were part-time. Hence, what was born then, frankly, she named it, because hiring a CMO and the chief marketing officer, you have to name something, right? So the Edison Edge is born about 9 years ago, and that entailed Edison Director Network Centers of Excellence. So think about FP&A, go-to-market, product and tech, and people leadership. Those are the centers of excellence we've stood up. And then last one is content and programming, like our CEO Summit that's next month. And we do roundtables. And then you'd be amazed at how often these people show up for these things if you actually provide a platform that's safe for conversation. So in other words, don't be there. Have a person who's sort of an operating partner that kind of been there, done it, lead those meetings. So long story short, it's real operators with real experience. But the difference, the way we do it, and there's some firms, 1 or 2 who have gotten pretty famous about their playbooks. Our playbooks are much more a set of kind of a framework than a playbook, because companies at our stage, right, again, 15, 20 million in revenue, it's got to be a little bit de novo. It's a little bit of the market model, go-to-market model, maybe a little different for company A versus B versus C. And we're also multi-vertical. So a fintech go-to-market model may be different than a enterprise software model. So all that being said, you really want deep depth on the centers of excellence. So in the last 3 years, we've gone from a handful of inside partners that are full-time to now adding about 6 operating partners they're full-time dedicated to us, but it's not their only job. They have a consulting practice on their own. So it's a pretty deep capability. And again, eye of the beholder, because everyone says they've got value add. That's the good and bad about, the cliche. I think what you see from us is Kelly coined this and I steal it and use it all the time. We sort of have this term pull versus push. Buyout firms push, right? They own the business. They're going to push the change, push the playbooks in. In our model, it's a pull model. The resources exist in diligence. And we want the great management teams to kind of pull us in. We give you a set of what we found in diligence, a 180-day plan, kind of a fast start kind of plan we agree to. Before we fund, we actually do a review of the 180 plan together. But you can use your resources, Mr. or Mrs. CEO and management team, or you can use some of the resources we provide. Or we have third parties, of course, we can bring to the party. And the point is, when you're a minority investor, you got to earn your way. And that's the pull. Mm-hmm. So when I know what's working is when we have 3 or 4 different COEs pulled into a deal right after diligence occurs, because they saw it as collaborative as opposed to sort of just a no offense, a proctology exam, right? It's like that diligence isn't really adding value if that's the way you're going about it.
Yeah. So where does the industry go from here? We talked about the gradient of change and the slope being higher in the past 5 years as it was in the previous 15. Do you think we're going to continually change at this rate, or what does the future of venture look like from your lens?
It's timely. I don't know when you'll post this, but it's October 13th and some PitchBook data came out today. So we had like the lowest quarter in a while of dollars deployed, but one of the highest quarters ever of capital raised, which is a real interesting recipe for this dry powder thesis. Like things are going to kind of burst again with deals getting done. Everyone thought Q3 might do that, right? You have slow Q2 and now a busy Q3. But I think in the short term, because there's 2 answers, right? We can debate whether we're in a recession or not. I think it's pretty clear we're in some amount of pullback and forced by the Fed. So I kind of look at this as a 3-year question and then a 10-year question, because I think it's going to take 3 years. I'm not predicting a 3-year recession, but it's going to be 12 to 18 months of pain. Especially if you're a public equity manager, it's probably going to feel really painful. In the private markets, what we're going to go through the next 3 years is you better have not only a path to profitability, you better have a valuation that made sense, or you're going to get a really ugly kind of cap table. Because what we're seeing, right, is, and we saw this in the dot-com boom and bust. And remember, I was in that zone. We were going to go public right as, frankly, 9/11 happened. So it was a really interesting I've seen this movie inside the operating business. Raising a round after you had a valuation that was headed for an IPO is really painful, right? So I saw participating preferred back in 2001, I guess it was. And when I got to Edison, they'd never heard of it, which is kind of funny. And we're starting to hear it again, right? You're starting to see structure again. I think there was just an article the other day about Klarna and Afterpay and kind of what's the real valuation, right? Some of these high-flying unicorns. So I think that's the 3-year pain. And that the big trick here for an entrepreneur is, again, talking my own book. At down rounds, you're not selling the company today. Keep your cap table clean instead of going and making a ton of structure that's just kicking the can down the road, because it's going to come back to haunt you at some point. And that's a really painful conversation, but value the business for what it's worth, not for what your last round was, I guess that's one thing the industry's going to go through. And there's a lot of young people, no offense, Nate, because I know I've got the gray hair to prove I'm a lot older than you, but the bottom line is there's people just haven't seen this movie, right? Yeah. If you just got in the industry in the last 5 or 10 years, you haven't seen this kind of situation. So I think you're at this 3-year reckoning of what was overfunded, what do the cap tables look like. If you go out 10 years, I think what's really interesting, to your point about enterprise kind of behaving like a business, venture firms no longer being a handful of people doing deals, really being thoughtful about how you deploy capital, being thoughtful about follow-on capital. Now I'm talking more the structure of the industry versus what trends we're going to invest in. I think there's no better time. I'm in the camp of great companies are born in tough times. We love entrepreneurs who either started a couple of years ago or will start now, because they really have to figure it out and they have to be capital efficient and really thoughtful about treating our money like their money or their parents' money, so to speak, or their grandmother's money is the way to think about it if you're an entrepreneur. So I think we've got that going for us for frankly, from right now going forward. I think the next 10 years, you're going to find the value add, or 5 or 10 years, the value add is going to come down market because you're competing as a smaller venture firm with some firms that have, as you said, multi-stage and have a lot more resources. So I think how management fees are deployed to really bring value to the companies is going to be a bit of a reckoning for earlier stage. I think it's going to come down market is my point. There'll still be founders, know people, and there's good network. You bring a great set of early stage investors together to do a smallish seed or A round. I think we're also going to see middle to long term rounds getting back to being sensible size wise, and nothing like a little pain to kind of get people back to their senses. So those are some of the things I'm kind of focused on. But in our shop, I think the good news is we've always been fundamentally driven, and I say that high growth, but also whether you use Rule of 40. I don't like this burn multiple. That was just a dumb thing to be talking about. And now it's coming up more like you better manage your burn multiple. No. If you have a burn multiple, you're probably going out of business or your current investors are going to fund you. That's short term what we're dealing with. But I think whether it's Rule of 40, whether it's a unit economic measure that's really important, this no longer becomes a luxury going out the next few years. It's going to be a sort of embedded. And again, we saw that. I think the good news that's for the industry, and the entrepreneurship like it too, LPs, when the dot-com bubble hit, they really pulled back and they missed good vintages. So some of my experience of having raised literally 6 different funds here at Edison, I think most LPs who are really good institutional know they can't kind of just take a vintage off, take a year off from investing. So 23 is going to be interesting because there's going to be denominator effect, which we can talk about if we want to. But the point is the LPs are going to be tight with their allocation, but they're not going to want to just sit it out. Mm-hmm. And that's what happened in the dot-com bust. They literally, venture became persona non grata for several years, and a lot of great outcomes were missed. So I think that's good news from what was learned from the last boom and bust cycle. This one, we should see some benefits for having a lot of LPs having seen that. I feel like they missed something.
Mm-hmm. What is your opinion of these crossover funds? Coatue, Tiger, I'd be curious to hear your perspective on what the future is for them. I mean, we've seen a number of the partners leaving. Yeah. And it seems like something's brewing under the surface. I'd love to get your perspective on that.
The ones who sort of stuck to growth, really growth and kind of the higher end of growth, and I think you see this, the ones who kind of got into late stage venture as a growth fund are the ones who overpaid and have companies that are bleeding way too much capital for even them that have, theoretically endless amounts of fund size, but they put big rounds in. So it's not as endless as they thought. I think what you're seeing, to your point about some of these departures, inside the shop, the folks who are doing venture's not going to be able to be done anymore. Right, because their LPs are going to hold them accountable. So you've got a little bit of this, what really made you money? Was it a growth kind of company or was it a venture business? I think that reckoning is happening inside these firms. And I don't want to call any of them out specifically because I only know a few really well. But I think that what's also happening is you've got some young people who are going, wait a minute, it really doesn't make sense to manage several $billion in a multi-stage firm. When am I going to see carry? There's just that's the reality. And you got some young people who made some good investments that want to go off on their own. So I think that always happens, but it's happening in spades when you look at fund size. Look, when you look at Andreessen, you just got to respect what they've built, to be honest, because that is an enterprise, right? Hundreds of people doing some really interesting things. But I think if I understand what he's done, what those two have done really well is they've kind of set them up as businesses inside. The different strategies really run independently. We've actually, inside our 10th fund, we've done control deals and minority deals. These are kind of $150 million enterprise value or less kind of buyout, but it's really because a founder says, I want to roll, but I'm okay giving up control. Because sometimes they don't know. But if fund size stays reasonable, you can pull that off. If fund size starts to get really big, and you're keeping kind of a multi-strategy inside, you got investment committee, where's my carry? It's all the stuff that kind of goes on inside a venture firm. Mm-hmm. Less interesting to an entrepreneur for your audience if you get too much into these weeds, or if I do. But here's what I'd say. If you're taking investment from a multi-stage firm or a multi-strategy firm, you better understand who's underwriting the deal. Because if you think you're a growth business, but your investor's the venture person inside that shop, that's going to come home to roost, or vice versa in the next round, or if you hit the skids. So there's sort of, for an entrepreneur, the advice there is you really want these firms on your masthead, on your website. This is great. I got, the best of the best, until you realize it's a mismatch for what you need in the next stage of your investment, life cycle. So I think from the entrepreneur perspective, it all became a logo chase as opposed to who's really investing, what do they know about my business, and how do I fit into their strategy?
Yeah.
So hopefully entrepreneurs start to ask some of those questions of the firms. They're going to be forced to now because there may not be reserves for follow-on when they need a capital. But I think when you look at kind of what it means to an entrepreneur, these multi-stage firms, the idea of all my capital is here for a long time is interesting until it doesn't happen.
Yeah.
And then you have to answer the question of, we have this big firm who've backed me. Why aren't they investing? We see a deal that someone's in that and we're going, wait a minute, they should be showing up, shouldn't they?
That's something we think about a lot for some of the companies we have that have options that take money from multi-stage funds. It comes at the risk if they don't want to double down in the B, the C, or whatever future round it might be.
That's exactly the two-edged sword. It's sort of like, you saw this in the data I was just referring to, the non-traditional, right? The strategic investor, the corporate VCs, and the family office, that pulls back first. You also see this in the multi-stage. They pull back things that don't feel like the core of what they do. So, again, the next couple of years, you're going to see, even a couple of quarters, you're going to see these problems. But that should be, to your point about a great early-stage investor or a valuable early-stage investor like yourselves, have the conversation with the CEO that really says, be careful. What you're wishing for may not be so great if all you're thinking about is the logo.
Yeah. Yeah. One thing that you mentioned in your answer was the difference between growth equity money and then true venture dollars. And there's an argument going on. I don't know if you've seen any of the Twitter feuds, but how do you define growth equity versus venture?
I have seen several of those feuds, partaken in a couple myself, but I generally do. I lurk and read and want to understand what the folks are yelling at each other about. And LPs ask this question because where our revenue stage is, again, 10 to 30 of revenue is our sweet spot. And our average deal in funds 9 and 10 were about 15, 18 million bucks. So that's not a venture company, right? But when you look at the bigger growth equity funds, some of these seem earlier to some LPs. So what I answer to my limited partners, number one, first institutional capital or less than 10 million bucks raised. Those two things, because if you got to 15 million plus, and I don't mean ARR, I don't mean run rate, I mean GAAP revenue, and you raise less than 10 million bucks, you're probably pretty capital efficient. But if we can get a first institutional capital company, which is about 2/3 of what we've done, I went back and looked at some data, not just for this, but for my own stuff as we get our next fund, kind of preparation together. Go back to Fund 7, which is the 2010 vintage. So our last 12 years, it's about 70% first institutional capital for a company doing 10 million or more in revenue. That to me is a checkbox of a growth firm versus a multi-stage VC firm. So when I talk to folks like you and you go, wait, so how does that even play when we've got an interesting company? Do we miss all those? I think the key is, did you raise 20 million bucks on your way to 5 or 6 million in revenue? That's a venture firm, right? They're raising Series C or Series D. They might get to double-digit revenue. They've got a really big idea, but it's been about kind of keep spending to figure it out. The other thing about venture businesses, in my opinion, versus growth equity businesses, how do you define success? Is it kind of billion or multi-billion or bust? And for us, when we look at kind of average valuation being 75 to 80 million bucks in our portfolio over the last couple funds, everyone can make money at 300 million bucks. Everyone can do really well, in fact. So we're underwriting kind of 3.5 to 4.5 times in our expected case. And if you're going to put money in at 250 or 400 million or 500 million pre, you need some really big outcomes. And as we're seeing, the market's not paying for those right now, right? The IPO market's closed.
Yeah.
So I think the other thing about growth equity is how do you find success? And are we doing this for kind of a rocket ship or bust? And frankly, that great venture capitalists do that well. People make a lot of money and do really well. We have great inventions, let's face it, and innovation. The bottom line is that that's not exactly what we're doing with our LPs. That's not what our LPs are investing in us for. So that's the other part, how this kind of question relates to the entrepreneurs. Really understand what your investor, your prospective investor, what they're modeling, what they're telling their LPs. Those are things that I think we're seeing a lot better from. I say that's something that's changed in the last 5 years. Entrepreneurs are asking harder questions. There's a lot more visibility, transparency. That's the last 10 years to our industry. But you still sometimes find a mismatch. Like you didn't really get at, there's a valuation argument that becomes, I want 100 million pre instead of this is the multiple, this is what we're underwriting, this is what we're thinking about. I tend to find entrepreneurs who take, the valuation conversation around ego and kind of like a report card. Wrong answer. What are we thinking about as our exit path? So I think those are some of the high level growth equity kind of check boxes, if you will. And the simple way to think about it, product, market, and execution risk, we think about it as execution risk. Or if you get to 10 or 15 or 20 million of revenue, you know the dogs are eating the dog food. You may underestimate or overestimate the market size, but the product's clearly working, but it's execution. Can I go from a founder sales model, the CEO making all the rain, maybe a VP of sales hires one salesperson? That's what you got, in a company like the ones we back. Can we now take that to 10, big quota-carrying salespeople, a whole bunch of SDRs, a whole bunch of BDRs, and scale sales and marketing? That's a growth kind of business as opposed to search for product market fit and search for the product being completed.
Yeah. Chris, if we could feature anyone on the show, who should we interview and what topic would you like to hear them speak about?
So I have two answers for you. One, I've been personally, this is like a personal sort of journey around COVID. I've been spending a lot more time in stoicism. And there's a guy named Ryan Holiday. He's actually become fairly famous. He's got a New York Times bestseller right now. But he really boomed, I think, in COVID. But The Daily Stoic is his, not only podcast, he's published a bunch of books. But I think the whole thing about stoicism is focus on what you can control. And you think about an entrepreneur's life, if they can focus on what they can control, there's so much noise around them. So Ryan has some really great stuff. And I would just say any listener would benefit from reading and listening to some of his stuff. The second, again, it's funny how this podcast thing kind of has turned into some really interesting learning for me. But there's a guy named Stephen Bartlett, Diary of a CEO. I have found his interviews, discussions just incredibly insightful. Some guests that are really just interesting. And his ability to get people talking about things you wouldn't expect to show up on a podcast in terms of transparency and kind of vulnerability. Amazing. So there's a couple names for you that I think you may want to ping.
Chris, what do you know that you need to get better at?
As I said, that journey of personal growth, first of all, if you ever stop learning, and I'm thinking you always don't put this on video, but you can see all my gray hair, but I haven't stopped learning. And because you can see when people graduated from school, you know how old I am. I think the bottom line is I want people to be as intense as I am. I'm learning that that's not the case. And I say that because it takes all types. It's not that they don't care. It's just people bring different styles to the table, and you need to respect that. So you'd think after 30 years of being in business, you'd kind of figure that out early on. But I continue to want people to kind of run the same, their motor as high as I do. And that's not actually the right recipe for success. That focus on what you can control. Look, as type A, high, sort of people want to be successful. We all sort of want to control things we can't control, right? And that's a lifelong journey in and of itself. I frankly would love to be a lot smarter about Web3. I spent a lot of time there, sort of back to an industry point. And is it dead or not in this current world? Who knows? But I do think as it really relates to kind of a burgeoning industry, I spent a lot more time in the creator economy too. So I want to get better and smarter on that.
And Chris, what is the best way for listeners to connect with you?
That's great. So I do try, and I'm sort of an inbox zero person. That doesn't mean I answer on the same day, but I do answer my emails. So with the good old email, I am not Mr. Big Twitter follower, but you certainly can ping me there with a DM. And then last but not least, we do have this podcast called Electrifying Growth as well, which we'd love to collaborate with you guys on. I've had listeners kind of ping me through that, which it's sort of gratifying because we're sort of just starting. So you get someone who listens and goes, hey, I heard you. I'd say the other thing is, as people investing, the connection point is always critical, right? To have someone shoot me a note that knows me, because that just, I don't want to let my network down, right? So if you're an entrepreneur, this is sort of fundraising 101, but have someone make the warm intro. I love cold emails if they're well written and well done, but you and I both know the trusted lawyer, the trusted angel investor, this trusted early stage investor, that goes right to the top of the list, right? The priority list. So I guess that's a little bit of a tip, but also I do try to answer every email. I'm probably guilty of missing a few, but I'm happy to do it.
Absolutely. Well, thank you again for coming on, Chris. This was a real pleasure.
Likewise, Nate. Thanks. Great to meet you. And thanks for having me.
Of course.
That will wrap up today's episode. Thanks for joining us here on the show. And if you'd like to get involved further, you can join our investment group for free on AngelList. Head over to angel.co and search for New Stack Ventures. There you can back the syndicate to see our deal flow, see how we choose startups to invest in, and read our thesis on investment in each startup we choose. As always, show notes and links for the interview are at fullratchet.net. And until next time, remember to over-prepare, choose carefully, and invest confidently. Thanks for joining us.